Hey there. Welcome back. Tonight we're going to talk about retirement accounts. How they work, where they came from, why they're set up the way they are. It's one of those topics that sounds like it should be complicated. But when you slow down and just walk through it piece by piece, it turns out to be pretty straightforward. We'll take our time. There's no rush. You're comfortable, and we're just going to ease into this together, one idea at a time, letting each piece settle before we move on to the next. So get comfortable, close your eyes if you'd like, and let's just start from the very beginning. The first thing worth knowing is that when you put money into a retirement account, something interesting happens to it right away. Not interesting in a dramatic sense, just interesting in the way that a small, quiet detail can be interesting once you notice it. The money doesn't just sit there. It gets a kind of special status, a designation that separates it from ordinary money sitting in an ordinary bank account. And that designation has a lot to do with taxes, which is really the central idea behind all of retirement saving. Think about taxes for a moment. Not in a stressful way, just as a concept. When you earn money from working, the government takes a portion of it. That's just how it works. You earn $100, you get to keep maybe 70 or 80 of it depending on your situation, and the rest goes to taxes. That happens before you even see most of your paycheck. It's already been calculated and withheld. So the money that ends up in your bank account on payday is already the after-tax version of what you earned. The tax part has already been taken out. Now, what if there were a way to set some of your money aside before that tax process happened? Before the government took its portion? You earn $100, and instead of the whole thing being taxed right away, you put 25 of it into a special account first, and only the remaining 75 gets taxed in the usual way. That's the basic idea behind one kind of retirement account. You get to delay the tax. You don't avoid it forever, but you push it off into the future, and that delay, as quiet and simple as it sounds, turns out to matter quite a lot over the course of decades. The reason it matters has to do with something called compounding, which is one of those concepts that feels almost too simple when you first hear it but becomes more profound the longer you think about it. Compounding just means that the money you've set aside can grow, and then the growth itself can grow, and then the growth on the growth can grow, and this process keeps going on and on. If you set aside $100 and it grows to $110, next year the $10 that appeared is also in the pile. So now $110 is doing the growing, not just 100. And over 20 or 30 years, this has a substantial effect on the final total. But here's what makes the tax delay particularly useful in that context. When the money is growing inside a retirement account, it's generally growing without being taxed year by year. In an ordinary investment account, if your money earns interest or dividends or capital gains in a given year, you typically owe taxes on those earnings that same year. You get a form in the mail, you report the income, you pay the tax. But inside a retirement account, that process is paused. The earnings just accumulate year after year, without being reduced by taxes each time. The compounding happens on the full amount rather than on a slightly smaller amount after taxes are taken out. And again, over decades, that difference adds up in a surprisingly significant way. There will eventually come a time when the money does get taxed. Generally, that happens when you take it out, when you actually withdraw it and use it for living expenses in retirement. At that point, the government collects what it's been waiting for. But by then, you're probably earning less than you were during your working years, which means you might be in a lower tax bracket, which means the taxes you finally pay might be a smaller percentage than they would have been if you'd paid taxes on every dollar as you earned it during your career. That's the logic anyway. The idea that deferring the tax and letting the money compound in the meantime can leave you with more in the end than you would have had otherwise. That basic structure, setting money aside before taxes, letting it grow untaxed for decades, and then paying taxes when you take it out, is the foundation of what most people know as the traditional retirement account. It's the foundation of accounts like the 401k and the traditional IRA. Those names are just labels, just shorthand for specific rules about how much you can contribute, who is eligible, and what happens if you take money out early. But underneath the names and the rules, the core idea is the same. Delay the tax. Let things compound. Pay later. And there's a variation on this idea, too. A different way of doing the same general thing. Instead of putting in money before taxes and paying later, you put in money after taxes and pay nothing later. You earn $100, you pay your normal taxes on it, you keep maybe $75, and then you put some of that already taxed money into a retirement account. The money grows inside the account just the same, without being taxed along the way. But when you eventually take it out in retirement, you owe nothing. No taxes on the withdrawals at all, because you already paid taxes on the money when it went in. This version is what most people know as the Roth account. Named after a senator who championed the idea in the late 1990s, William Roth of Delaware. The name is just a proper noun, a label attached to a set of rules, but those rules carry the same underlying intention as the traditional version. Help people build savings that will last. Whether the traditional or the Roth approach turns out to be better for any particular person depends on a lot of things, mainly the question of whether your tax rate is higher now or whether it will be higher later. If you expect to be in a higher tax bracket in retirement than you are today, the Roth is appealing because you lock in today's lower rate. If you expect your tax rate to be lower in retirement, the traditional approach is appealing because you delay the tax to a point when it will cost you less. Most people don't know for certain which situation applies to them, and that uncertainty is fine, because both versions are genuinely useful tools, and many people use both at different stages of their lives. Let's take a step back from the mechanics for a moment, and just think about what these accounts are trying to do in a broader sense. They exist because retirement saving is genuinely hard without some kind of help or incentive. It's not that people are careless or short-sighted. It's just that there's a natural human tendency to weight the present more heavily than the distant future. If you have $100 today and you can either spend it on something enjoyable right now or put it away for 30 years from now, the pleasure of the present thing is vivid and immediate, and the benefit of the future thing is abstract and far away. That's not a character flaw. It's just how human attention and motivation tend to work. So the tax benefits built into retirement accounts are, in a sense, a way of nudging the math. They make the future things slightly more appealing by making it slightly more efficient than it would otherwise be. If putting money in a regular savings account and putting money in a retirement account were exactly equivalent in every way, many people would just use the regular account or no account at all and spend the money today. The tax advantage tips the balance a little. It gives the future version of yourself a slightly better deal, enough of a better deal that more people end up saving more than they otherwise would. That's the design intention, at least. Now, the accounts that most working people encounter are the ones connected to their employers. The 401k is probably the most familiar name in this category. The name itself is just a reference to a section of the tax code. Section 401, subsection K. It's not a particularly evocative name, not like Roth, which at least sounds like a person. But the 401k became the dominant vehicle for workplace retirement savings over the past few decades, and understanding why it came to dominate requires going back a little in time. There was a period, roughly from the 1940s through the 1970s, when many workers in large companies could expect something called a pension. A pension is different from the accounts we've been talking about. With a pension, the company promises to pay you a certain amount of money every month after you retire, for the rest of your life. You don't manage any investments yourself. You don't choose how the money is allocated. You just work for the company, earn your pension benefit according to a formula typically based on your years of service and your salary near the end of your career, and then in retirement, the checks arrive. The company handles everything in between. They invest the money, they take on the risk, and they guarantee the outcome. That sounds like a very comfortable arrangement, and for people who spent long careers at stable employers, it was. But it also had costs that eventually became difficult to sustain. Companies were promising future payments that could stretch out for decades, and those promises showed up as enormous liabilities on their balance sheets. If a company promised pensions to tens of thousands of retirees, it needed to have the money to pay those pensions even if business turned bad, even if the investments made with pension funds didn't perform as expected, even if the company itself was struggling. Many companies eventually found that they had made more promises than they could keep, and pension funds went underfunded. People who had counted on those monthly checks found them reduced or eliminated. And so, gradually, the center of gravity shifted. The 401k rules had existed since 1978, but they weren't originally intended to replace pensions. The rules simply allowed certain kinds of deferred compensation arrangements in large corporations. It was actually a benefit consultant named Ted Benna who in 1980 noticed that these rules could be used to create a very flexible, tax-advantaged savings vehicle, and he implemented one of the first actual 401k plans for his employer. The idea spread. Companies realized they could offer these plans at far lower and more predictable costs than traditional pensions. Workers would contribute their own money, the company might add some matching contributions, and the investment decisions and the associated risks would rest with the individual employee rather than the company. Whether that shift was good or bad is a question people have different views on. On one hand, workers gained more portability. If you left a job, your 401k balance was yours, and you could take it with you rather than losing years of pension accrual. You had control over how your savings were invested. On the other hand, you also bore all the risk. If the stock market declined sharply right before you retired, that was your problem, not the company's. Pensions had guaranteed the outcome. 401k plans guarantee nothing except the tax structure. The actual result depends on how much you contributed, how long the money had to grow, and how the investments performed. It's a trade that most workers made without much conscious deliberation, because the decision was largely made for them by the companies that employed them. Pensions were phased out over years and decades. 401k plans were offered in their place, and that became the new normal. Today, a traditional pension covering private sector workers is relatively rare. It still exists in some industries and in many government and public sector jobs, where defined benefit plans remain more common. But for most people working in the private sector, the retirement planning system they inhabit is one where the responsibility falls substantially on the individual. Let's walk through what actually happens when someone starts a new job and has a 401k available to them. The first thing that happens, often, is that the employer tells them they can enroll in the plan. At many companies today, enrollment is actually automatic. You're enrolled by default, contributing some small percentage of your salary unless you actively opt out. That design choice, automatic enrollment versus requiring active opt-in, turns out to have a large effect on how many people actually end up saving. When people have to do something to start saving, many of them never get around to it. When they have to do something to stop saving, many of them just leave it as is. The inertia works in the direction of saving rather than against it. Once enrolled, you're typically asked to choose how much to contribute, expressed as a percentage of your salary. Let's say you choose 6%. If you earn $50,000 a year, that's $3,000 a year going into the account. That $3,000 is taken out of your paycheck before income taxes are calculated, so in a very real sense, it costs you less than $3,000 of take-home pay. The amount it actually reduces your take-home depends on your tax bracket, but if you're in a 22% tax bracket, for example, then that $3,000 only reduces your take-home pay by about $2,340. The rest would have gone to taxes anyway. The retirement account lets you redirect that portion to yourself instead. Many employers also offer something called a match. The most common version is something like this. The employer will contribute 50 cents for every dollar you put in, up to a certain limit. If you contribute 6% of your salary, the employer adds another 3% on top. That's an instant 50% return on your contribution, which is quite a meaningful incentive. Financial advisors often describe not contributing at least enough to capture the full employer match as leaving money on the table, because that's essentially what it is. The match is part of your compensation, and if you don't contribute enough to receive it, you simply don't receive that portion of your pay. After the contribution piece is figured out, there's the question of what the money actually goes into. A 401k plan typically offers a menu of investment options, usually mutual funds of various kinds. There will often be a selection of stock funds, bond funds, and balance funds that hold a mixture of both. The stock funds might include some that track a broad index of American companies, some that focus on international companies, some that focus on specific sectors or company sizes. The bond funds offer a different kind of investment, generally less volatile than stocks but also with lower expected returns over time. This is the place where many people feel a kind of mild overwhelm, because choosing among investment options is a new skill for most people, one that doesn't come with much instruction. The concepts involved aren't particularly difficult, but they aren't taught in school, and most people encounter them for the first time when they're filling out paperwork at a new job and need to make a decision quickly. The good news is that most 401k plans now include what are called target date funds, which are designed to remove most of that decision-making burden. A target date fund is a single fund that contains a mix of stocks and bonds, and that mix automatically becomes more conservative as you approach a particular year, the year you expect to retire. You pick the fund with the year closest to your anticipated retirement, put all your contributions in it, and the fund gradually adjusts on your behalf as the years pass. The logic behind that gradual shift from stocks to bonds is worth understanding. Stocks, broadly speaking, tend to grow more over long periods of time but also fluctuate more in value in the short term. A stock fund can lose 20 or 30% of its value in a bad year. Bonds fluctuate less and offer more stability, but they also tend to grow more slowly over the very long run. When you're young and retirement is 30 or 40 years away, the short-term fluctuations of stocks don't matter very much, because you have decades for the market to recover before you need the money. You want the long-run growth potential. But as you get closer to retirement, the short-term fluctuations start to matter more, because a big market decline right when you're about to stop working and start spending your savings could genuinely be a problem. So the conventional wisdom is to gradually shift toward more bonds and less stocks as retirement approaches, reducing volatility at the cost of some expected growth. Target date funds automate that process. Once the money is in the account and invested, the general idea is to leave it alone. That's actually one of the harder aspects of the arrangement for many people. Not because the money disappears, but because it's sitting there invisible, and life being what it is, situations arise where it seems tempting or necessary to access it. The rules around retirement accounts generally impose penalties for withdrawing money before age 59 and a half. If you take money out before that age, you typically owe both the income taxes on the withdrawal and an additional 10% penalty on top of that. The penalty is intentional. It's there to discourage early withdrawal and to reinforce the purpose of the account, which is long-term retirement saving, not general-purpose emergency saving. There are exceptions to the early withdrawal penalty, a list of circumstances under which the penalty doesn't apply. Financial hardship can qualify in some situations. Certain medical expenses. Permanent disability. A first-time home purchase in the case of IRA accounts. The birth or adoption of a child is a more recent addition to the list. The rules around these exceptions have their own details and nuances, but the general principle is that the penalties exist to protect the function of the account while allowing for genuine emergencies. The reason the government is so invested in keeping the money in the account until retirement age, aside from the obvious fiscal interest in eventually collecting the deferred taxes, is that the entire structure only works as intended if the money actually stays invested and growing over a long period of time. A retirement account that people dip into frequently during their working years doesn't accomplish its purpose. The whole point is that the money sits there for decades, compounding, and then is available to you when you need it most, which is after your income from work stops. Speaking of that final stage, let's think for a moment about what retirement itself actually looks like from a financial standpoint. You've been saving for decades. You've been contributing to your accounts, reinvesting dividends, watching the balance grow. You retire. Now what? The money doesn't automatically convert itself into a monthly paycheck. You have to start drawing from it, which raises questions about how much to draw, in what sequence, from which accounts. One commonly cited guideline is the 4% rule, which emerged from financial research in the 1990s and has been discussed and debated ever since. The basic idea is that if you start retirement by withdrawing 4% of your total savings in the first year, and then adjust that amount each year for inflation, there's a reasonably high probability that your money will last 30 years without running out. If you have $1 million saved, you could withdraw about $40,000 in your first year of retirement. Adjust that figure slightly upward each year to keep pace with inflation, and based on historical market performance, that portfolio would have lasted through most 30-year periods. The 4% rule isn't a guarantee, and it wasn't designed to be. It's a rough guideline based on historical data, and different researchers using different assumptions arrive at slightly different numbers. Some argue 3% is safer. Others suggest 5% is reasonable in certain circumstances. The right number for any particular person depends on things like how long they expect to live, what other sources of income they have, how much flexibility they have to reduce spending in a bad market year, and how the market performs during their specific retirement years. But as a general framework for thinking about how much you need to save before retiring, it's useful. If you plan to spend $40,000 a year in retirement, and you're using the 4% rule as a guideline, that suggests you need about $1 million saved. $50,000 a year suggests you need $1.25 million, and so on. There are other sources of retirement income that factor into this calculation, of course. Social Security is the most significant one for most Americans. Social Security is a federal program that sends monthly payments to retirees, and those payments are based on your earnings history during your working years. The program has its own separate structure, its own contribution mechanism in the form of payroll taxes, and its own rules about when you can start collecting and how much you receive. We'll come back to Social Security in more depth shortly. For now, the point is that most people's retirement income picture is a combination of things: money drawn from personal accounts like 401ks and IRAs, Social Security payments, possibly some pension income if they worked for an employer that still offered pensions, and potentially income from other assets like rental property or part-time work. The mix of these sources varies enormously from one person to the next, which is part of why retirement planning is so individualized. There's no single right answer that applies to everyone. But the accounts we've been discussing, the 401k plans and the individual retirement accounts are the most widely available and tax-advantaged tools available to private sector workers, and they form the center of most people's retirement savings strategy. Let's talk more specifically about the individual retirement account, or IRA, since we've mentioned it alongside the 401k but haven't gone into much detail yet. The IRA is separate from any employer. It's an account you open on your own, at a brokerage or a bank or a financial institution, and it operates according to its own set of contribution limits and rules. As of the early 2020s, the annual contribution limit to an IRA was significantly lower than the 401k limit, around $6,000 or $7,000 per year for most people, compared to over $20,000 for a 401k. But the IRA is available to anyone with earned income, regardless of whether their employer offers a retirement plan. There are two main types, the traditional IRA and the Roth IRA, and they work exactly as you'd expect based on what we've already discussed. The traditional IRA allows pre-tax contributions, which means you may be able to deduct the contribution from your taxable income, reducing your tax bill in the year you contribute. The Roth IRA takes after-tax contributions, and the withdrawals in retirement are tax-free. One important nuance is that the tax deduction for traditional IRA contributions phases out at certain income levels if you also have access to a workplace retirement plan. If your income is above those thresholds and you have a 401k at work, your traditional IRA contributions might not be deductible, which changes the calculation about whether a traditional or Roth IRA is more useful. The Roth IRA also has income limits on who can contribute directly. Above certain income thresholds, you can't contribute directly to a Roth IRA. However, there's a workaround called the backdoor Roth, which involves contributing to a non-deductible traditional IRA and then converting those funds to a Roth. This is legal, it's fairly common among higher earners, and the name sounds more complicated than the process actually is. It's just a two-step movement of money from one type of account to another, with some attention to the tax treatment of any existing IRA balances. The flexibility and accessibility of the IRA makes it a useful complement to a 401k. If your 401k has limited or high-cost investment options, an IRA might give you access to a broader range of funds with lower fees. If you want to save more than your 401k allows, an IRA gives you an additional bucket to fill. And if you change jobs frequently or work for yourself, the IRA is always available in a way that a 401k is not. Speaking of self-employment, there are versions of retirement accounts specifically designed for people who work for themselves or run small businesses. The most accessible of these is the SEP IRA, which stands for Simplified Employee Pension. The word simplified is doing a lot of work in that name, because the SEP IRA really is remarkably simple to set up and use. You open an account, you contribute money, you get a tax deduction, the money grows, and you take it out in retirement. The contribution limit is much higher than a standard IRA, tied to a percentage of your self-employment income, which means someone with a successful freelance or consulting practice can set aside quite a substantial amount each year. There's also the Simple IRA, which is intended for small businesses with employees. And for self-employed individuals who want even higher contribution limits, there's the solo 401k, also called an individual 401k, which allows contributions both as the employee and as the employer, essentially doubling up. A freelancer or sole proprietor using a solo 401k can often set aside more than they could with any other type of account, which can be a significant advantage during high-earning years. These options for self-employed workers and small business owners exist because the original 401k structure was built around the employer-employee relationship, and millions of people don't fit neatly into that structure. The tax code has developed a set of parallel rules to give comparable opportunities to people working outside of traditional employment. The basic incentive is always the same, some version of setting aside pre-tax or after-tax money, letting it grow without being taxed along the way, and accessing it in retirement. The specific rules and limits differ, but the underlying logic doesn't. Let's step back even further now and think about Social Security, because it's really the foundational retirement program, the one that exists underneath all the voluntary account-based saving we've been discussing. Social Security is a federal program that began in 1935 as part of the New Deal, during a period when the country was in the depths of the Great Depression. Before Social Security existed, there was no broad federal system to provide income to elderly Americans who could no longer work. Some people had pensions, mostly from government or military service. Some had family support. Many had very little. The Social Security Act created a system of insurance for workers, funded by payroll taxes paid both by employees and employers. A worker would contribute a portion of their wages throughout their career, and in return, they would receive monthly payments starting in old age. The system wasn't a savings account in the traditional sense, where your contributions are held in a fund and returned to you later. It was, and remains, more like a pay-as-you-go system, where current workers' contributions fund current retirees' benefits. The contributions of people working today are paying the benefits of people who retired today, and future workers will fund the benefits of today's workers when they eventually retire. That structure has both strengths and vulnerabilities. The strength is its resilience. As long as there are workers contributing to the system, benefits can be paid. The vulnerability is demographic. When there are many workers relative to each retiree, the math works comfortably. When the ratio shifts, because birth rates fall or because large generations reach retirement age at the same time, the math becomes more strained. The aging of the baby boom generation, that large cohort of Americans born in the years after World War II, has placed noticeable pressure on the Social Security system, and debates about how to ensure the program's long-term solvency have been ongoing for decades. For an individual worker, Social Security operates fairly simply. Throughout your working years, you and your employer each pay a percentage of your wages as Social Security taxes. These contributions are tracked, and your eventual benefit is calculated based on your lifetime earnings record, specifically the 35 highest earning years of your career. The more you earned over your working life, the higher your Social Security benefit will be, though the relationship isn't perfectly linear. The formula is weighted to provide proportionally higher benefits to lower earners, which is a redistributive element built into the system. When you're eligible to start collecting Social Security depends on when you were born and when you choose to start. The full retirement age for most people currently working is 67. You can start collecting as early as 62, but if you do, your monthly benefit is permanently reduced. You can also delay collecting past full retirement age, up to age 70, and for every year you delay, your monthly benefit increases. The decision about when to claim Social Security is one of the more significant financial decisions a retiree makes, because it affects the size of every monthly payment for the rest of their life. The break-even calculation for claiming early versus late is a kind of bet on longevity. If you start collecting at 62, you receive smaller checks but you receive more of them. If you wait until 70, you receive larger checks but you've missed 8 years of payments. At some age, the total cumulative payments from both strategies equalize, and beyond that age, the person who waited comes out ahead. That break-even age is typically somewhere in the late 70s or early 80s, depending on the specific benefit amounts involved. People in good health who expect to live into their 80s or 90s are generally better off waiting. People with significant health concerns might prefer the guaranteed income of starting earlier. It's also worth noting that Social Security has features beyond just the retirement benefit. Spouses of workers are eligible for benefits based on their partner's work record, even if they didn't work themselves or had lower earnings. Widows and widowers can receive survivor benefits. Disabled workers can receive disability benefits before reaching retirement age. Children of retired, disabled, or deceased workers can receive benefits in some circumstances. The system is more comprehensive than just a retirement income program, though retirement is its most visible function. Now, coming back to the voluntary accounts for a moment, there's one aspect of their structure we haven't really discussed yet, which is what happens inside them. We've talked about contributions going in and withdrawals coming out, but in between there's this period of potentially decades when the money is invested and hopefully growing. What does that process actually look like? When you invest inside a 401k or an IRA, you're generally choosing among a set of funds. A fund is just a collection of investments pulled together. When you buy a share of a fund, you own a tiny piece of all the underlying investments. The most basic distinction is between actively managed funds and index funds. Actively managed funds hire professional portfolio managers to decide which stocks or bonds to buy and sell, with the goal of performing better than the overall market. Index funds, by contrast, simply hold all the investments in a particular index, a benchmark like the S&P 500, which tracks 500 large American companies. There's no manager making individual stock picks. The fund just holds whatever the index holds, in proportion to each company's size. The comparison between active and index funds is one of the most well-documented debates in investment finance. The overwhelming body of research suggests that, over the long term, most actively managed funds underperform their benchmark index funds, especially after accounting for their higher fees. This isn't a controversial finding at this point. It's repeated in study after study. The reason most active managers fail to beat the index isn't necessarily because they're unskilled. It's partly because markets are competitive and information is widely available, making consistent outperformance genuinely difficult, and partly because the fees charged by active funds reduce returns dollar for dollar while index fund fees are very low. This research is why index funds became so popular among individual investors and eventually why they became the default recommendation for most ordinary retirement savers. John Bogle, the founder of Vanguard, made it his mission to bring low-cost index funds to ordinary investors, arguing that taking what the market gives you without paying large fees was a more reliable path to long-term wealth than attempting to outguess the market. Vanguard launched its first index fund in 1976, and it was initially mocked by parts of the investment industry as uninspired. Today, index funds represent trillions of dollars of assets and are the most common type of investment in many 401k plans. The concept of diversification is closely related. Diversification means spreading money across many different investments rather than concentrating it in a few. The logic is simple. Any individual company can have bad years, stumble, or even fail. But it's very rare for hundreds of companies across many industries all to suffer at the same time. A broadly diversified index fund that holds hundreds or thousands of companies is protected against the failure of any one company by the strength of all the others. The worst that can happen to a broadly diversified fund is that the overall economy struggles, which does happen but tends to be temporary over long time horizons. There's a saying in investment circles that diversification is the only free lunch, meaning it's the one way to reduce risk without giving up expected return. Every other risk reduction strategy involves some trade-off. Holding bonds instead of stocks reduces volatility, but also reduces expected returns. Holding cash reduces volatility even more but even further reduces expected returns. But diversifying within stocks, holding many stocks instead of a few, reduces the risk of any individual company without reducing the expected average return. You're still capturing the overall growth of the economy, just not taking on the unnecessary extra risk that comes from concentrating your bets. All of this, the account structures, the contribution limits, the investment choices, the fee considerations, the diversification principles, fits together into a system that, when it works as intended, helps ordinary working people build substantial savings over long careers. The numbers can be quite impressive when you see them laid out over decades. A 25-year-old who starts contributing to a 401k, invests in a diversified low-cost index fund, keeps contributing consistently through their career, and leaves the money untouched can, at a fairly modest contribution rate, end up with a substantial balance by 65. The math of compounding over 40 years is genuinely powerful. But the system also has places where it doesn't work as well. People who work in low-wage jobs may not have enough margin in their income to contribute meaningfully to retirement accounts, even with the tax advantages. People who work part-time or in jobs without employer-sponsored plans may not have easy access to the workplace accounts that make automatic saving most convenient. People who change jobs frequently, especially in the early stages of a career, may not be fully vested in employer-matched contributions, meaning if they leave before a certain period of time has passed, they forfeit part of the match. and people who face financial crises, a medical emergency, a period of unemployment, a major unexpected expense, may end up withdrawing from their retirement accounts early, paying the taxes and penalties, and setting their long-term savings back by years. These aren't problems with any individual's planning. They're structural features of the current system, and they've been the subject of policy discussions for decades. Various proposals have been made over the years to address gaps in coverage, to make it easier for low-wage or part-time workers to access retirement savings vehicles, to provide some basic level of retirement security more universally. Some of these proposals have become law, in the form of legislation like the Secure Act and its successor the Secure 2.0 Act, which made various adjustments to contribution limits, required minimum distribution ages, and rules about when part-time workers must be allowed to participate in employer plans. The system continues to evolve, with Congress periodically revisiting the rules and making adjustments. One of the adjustments that came with recent legislation is the increase in what are called required minimum distributions, or RMDs. Once you reach a certain age, the IRS requires you to begin taking minimum withdrawals from traditional retirement accounts. The reason is that all that money was put in pre-tax and has been growing untaxed for decades, and at some point the government wants to start collecting the deferred taxes. If people could leave money in traditional accounts indefinitely, passing them to heirs without ever paying taxes, the tax deferral would become a permanent tax avoidance rather than a temporary delay. The RMD rules prevent that by requiring annual withdrawals starting at a specified age, currently 73 for most people and set to rise to 75 under rules that will phase in over coming years. The amount you're required to withdraw each year is calculated based on your account balance and your life expectancy according to IRS tables. You don't necessarily have to spend the money, just take it out of the retirement account. You can reinvest it in a regular taxable account if you don't need it for current expenses. But you have to take it out, report it as income, and pay taxes on it. Failing to take your required minimum distribution results in a substantial penalty, which used to be 50% of the amount that should have been withdrawn. That penalty was recently reduced to 25% and can be as low as 10% if the error is corrected promptly, but it's still a significant penalty that most people would prefer to avoid. Roth accounts have a different rule on this front, which is one of their advantages. Traditional Roth IRAs have no required minimum distributions during the account owner's lifetime. The money can be left in the account indefinitely, growing tax-free. This makes the Roth IRA particularly attractive as an estate planning tool, because money left in a Roth can pass to heirs who can then draw from it over time, with the tax-free nature of the distributions preserved. Roth 401k accounts, which are the workplace version of the Roth structure, did have RMD requirements historically, but recent legislation changed this to bring them in line with Roth IRAs, meaning Roth 401k balances can now be rolled into a Roth IRA to avoid required distributions as well. Rollovers are worth discussing briefly because they come up frequently in people's financial lives, particularly when they change jobs. When you leave an employer, you have several options for what to do with your 401k balance. You can leave it in the old plan if the plan allows it. You can roll it into your new employer's 401k if the new employer accepts incoming rollovers. You can roll it into an IRA. Or you can cash it out, which means taking the money now, paying taxes and the early withdrawal penalty if you're under 59 and a half. The cashing out option is almost always the worst choice financially, because of those taxes and penalties. But it's also the one some people take when they're in financial difficulty or simply don't know what else to do. A rollover from a 401k to an IRA is generally handled in one of two ways: a direct rollover, where the money goes straight from the old plan to the new account without passing through your hands, or an indirect rollover, where the money is sent to you and you have 60 days to deposit it into the new account. The indirect rollover has some complications, most notably that the old plan is required to withhold 20% of the distribution for taxes, even if you intend to put the money straight into an IRA. If you want to roll over the full amount, you have to come up with the withheld 20% from your own funds and deposit the full amount within 60 days, after which you get the withheld amount back when you file your taxes. Most people prefer the direct rollover to avoid these complications. Now let's slow down a little and think about fees, because fees are one of the most significant and least visible factors affecting how retirement accounts perform over time. Every mutual fund charges an expense ratio, a percentage of your assets that's taken out each year to pay for the costs of running the fund. For actively managed funds, this might be 1% or more per year. For index funds, it might be 0.05% or even lower, 0.1%. The difference sounds trivial, and in any single year it is. But over decades, the difference is very large. If you invest $100,000 and it grows at 7% per year before fees, and you're paying 1% in fees, your actual annual return is closer to 6%. If you're paying 0.1%, your return is about 6.9%. Compounded over 30 years, the difference between 6 and 6.9% on a $100,000 initial investment is quite substantial. The lower fee account ends up with considerably more money, even though the underlying market performance was identical, and the only difference was the fee. This is why so much attention has been paid to expense ratios in recent years, and why the shift toward low-cost index funds has been so consequential for ordinary savers. Beyond the expense ratios of the funds themselves, 401k plans sometimes charge their own administrative fees on top of the fund fees. These might appear as an annual dollar amount charged to each account, or as an additional percentage. They exist to pay for the cost of administering the plan, keeping records, providing statements, offering customer service. Some plans are more expensive than others, and the quality of a 401k plan, in terms of the investment options available and the fees charged, can vary a great deal. Workers at large companies typically have access to better plans with lower fees, because large employers can negotiate better terms. Workers at small companies often have more limited options and higher costs, simply because of scale. The fee awareness among individual savers has grown considerably over the past 2 decades, partly due to regulatory changes that required more disclosure, and partly due to the general spread of financial literacy information. People who would never have thought to look at an expense ratio 20 years ago now routinely compare it when choosing between fund options. This shift in awareness has been genuinely beneficial. There's another layer of the retirement planning picture that often gets less attention, which is the psychological side of it. Not the psychology of saving versus spending, which we touched on earlier, but the psychology of watching your account balance fluctuate over the years and not doing anything hasty. Stock markets go up and they also go down, sometimes substantially and suddenly. A well-diversified portfolio invested in stock index funds might lose 20 or 30% of its value during a serious market downturn, and those downturns can last months or even years before the market recovers. For a long-term investor who's still decades away from retirement, a downturn like that is, in a financial sense, an opportunity. The contributions going in each month are buying more shares at lower prices, which means the eventual recovery will benefit them more. But that intellectual understanding doesn't always quiet the emotional discomfort of watching your savings balance fall sharply. The natural human response to loss is a desire to do something, to take some action that feels protective. In investing, that action often makes things worse. People who sell their investments during a downturn lock in their losses and then often miss the recovery. The phrase that financial advisors tend to repeat is something like time in the market beats timing the market, meaning that staying invested continuously produces better results than attempting to move in and out based on predictions about when markets will rise and fall. This isn't just a saying. It's supported by extensive research. The days with the largest market gains and the days with the largest losses often cluster near each other, and missing just the best few days in a decade, because you were out of the market trying to avoid the worst days, can dramatically reduce your long-term returns. The most powerful thing most people can do with a retirement account is also the least exciting thing: contribute consistently, invest in diversified low-cost funds, and then largely leave it alone for decades. This is easier said than done, of course. The market fluctuations that test investor patience don't occur in calm economic times. They occur during recessions, during financial crises, during global events that feel destabilizing. It takes a kind of deliberate calm to stay the course when the news is alarming and when your account balance has dropped significantly. The automatic nature of 401k contributions, where money goes in from each paycheck without requiring any active decision, helps with this. The money is invested without you having to choose to invest it in that particular moment, which removes the emotional friction of actively deciding to buy when everything feels uncertain. Asset allocation, the mix between stocks and bonds that we discussed earlier, is one of the primary tools for managing the emotional and practical challenge of volatility. A portfolio that's heavily weighted towards stocks will fluctuate more dramatically, both up and down, than one that also holds significant bonds. For people who find large fluctuations distressing or who are close enough to retirement that a big downturn could genuinely affect their plans, holding more bonds provides a buffer. The cost is lower expected returns over time. The benefit is a smoother ride and more predictability. This trade-off between expected return and volatility is at the heart of most portfolio design decisions. There's no objectively correct answer. It depends on your time horizon, your financial situation, and your psychological temperament. A person who genuinely doesn't lose sleep over seeing their account balance drop 30% in a bad year, who can hold steady and trust the long-term picture, probably benefits from holding a higher allocation to stocks. A person who finds those drops deeply distressing and is tempted to sell, or who is close enough to retirement that they don't have time to recover from a large downturn, probably benefits from holding more bonds even at the cost of some expected growth. Target date funds, as we mentioned, handle this automatically. They're built on the assumption that most people want to start aggressive and gradually become more conservative as retirement approaches, and they adjust accordingly without requiring any action on the investor's part. They're not perfect for everyone, because they make assumptions about the average investor that might not match any particular individual's situation. But for people who want a simple, set it and forget it approach, they're a reasonable solution. Let's think for a moment about the longer arc of all this, going back to where retirement savings stood before any of the modern account structures existed. Before the IRA, before the 401k, before even the widespread use of pensions in the private sector, the basic system of financial support for older people who could no longer work was the family. Extended family networks, adult children supporting elderly parents, was the primary mechanism by which people survived old age without income. Some form of this existed in virtually every culture. Older people who had resources gave them to their adult children while building a relationship in which those children would later provide support. The home, the farm, the accumulated possessions of a lifetime were all part of this informal web. For those without family support, there were often informal community structures, churches, benevolent societies, neighbors. The poorhouse was a real institution in American history, a place where people without means or family could be housed and minimally cared for in old age, though the conditions were often grim. The idea that old age poverty was a social problem to be addressed through policy, rather than just a private misfortune to be endured, gained gradual acceptance through the late 19th and early 20th centuries. Some states began experimenting with old age pension programs in the early 20th century, though these were generally modest and not universally available. The Great Depression accelerated the political pressure for a federal solution, as enormous numbers of older Americans found themselves without savings, without work, and without family resources that could support them. The Social Security Act of 1935 was the legislative response to that crisis, establishing for the first time a national system of retirement income insurance funded through payroll contributions. The early decades of Social Security were characterized by more workers supporting fewer retirees. The program began collecting contributions in 1937 and paying benefits in 1940, starting with a relatively small pool of retirees and a large workforce. Benefits grew modestly over the following decades as Congress expanded coverage and incrementally increased payments. A major expansion came in the 1950s when coverage was extended to self-employed workers, agricultural workers, and others who had originally been excluded. But by the early 1970s, some of the vulnerabilities of private pensions were becoming apparent. stories of workers who had spent decades with a company only to find their pension benefits reduced or eliminated when the company's pension fund was insufficiently funded created pressure for reform. The Employee Retirement Income Security Act, known as ERISA, was passed in 1974 and established minimum standards for private pension plans, requiring funding standards, creating insurance protections through a new agency called the Pension Benefit Guaranty Corporation, and establishing various fiduciary duties for plan administrators. ERISA also created the IRA, the Individual Retirement Account, as a savings vehicle for workers who were not covered by employer pension plans. The introduction of the IRA in 1974 was a significant step toward the individualization of retirement saving. For the first time, ordinary workers had a tax-advantaged account that belonged entirely to them, not to their employer. They could open it themselves, make contributions themselves, and keep it as they moved between jobs. The contribution limits were initially quite low, and the IRA wasn't widely used at first, but it established a template that would prove extremely influential. Then came the 1978 tax legislation that included the provisions that would eventually become the 401k. The original intent was to allow company executives to defer portions of their compensation in a tax-advantaged way. But the benefit consultant Ted Benna, whom we mentioned earlier, noticed that the language could be applied more broadly and more democratically, creating a system that could benefit ordinary workers, not just executives. His innovation of applying the rules to a broad-based employer-sponsored savings plan, with both employee and employer contributions, set off a transformation in how American workers thought about and structured their retirement savings. The timing aligned with a broader shift in the economy and in thinking about employment. The era of lifetime employment at single large employers was already beginning to fade by the early 1980s. Corporate restructuring, increased international competition, and a changing labor market all created more turnover, more career switching, and less of the stable long-term employment relationship that pensions were designed for. The portability of the 401k, the fact that your balance was yours and went with you, fit the emerging realities of working life better than the pension did. Over the 1980s and 1990s, 401k plans proliferated and contribution limits were gradually raised. The Roth IRA was created in 1997, adding the after-tax, tax-free withdrawal option to the toolkit. Contribution limits for both 401k plans and IRAs have been periodically increased by legislation, and in some years by inflation adjustments built into the law. The investment options available within 401k plans expanded over the same period, from fairly limited menus to much richer selections, including the target date funds that are now so central to most plans. Throughout all of this, there's been ongoing discussion and debate about whether the shift from pensions to individual accounts was actually good for workers as a whole. The critics of the shift point to several concerns. Most people are not well equipped to make investment decisions. Requiring workers to manage their own portfolios exposes them to risks that they may not understand and that pensions protected them from. Many people undersave, either because they don't understand the importance of starting early, or because they don't have the margin in their finances to save adequately, or because they make decisions that seem logical in the short term but damage their long-term savings, like cashing out a 401k when switching jobs. These critiques are not without merit. Studies consistently show that retirement savings are inadequate for a large portion of the population, particularly lower-income workers and those who spent significant time outside the formal labor market. The median retirement account balance for Americans near retirement age is far lower than what most financial guidelines would suggest is needed for a comfortable retirement. The system, as currently constituted, works well for workers who have stable employment histories, decent incomes, and access to good employer plans, and it works less well or not at all for those who don't. The defenders of the current system point to the genuine improvements in coverage and in the value of tax advantages that the current accounts provide. They also note that many people do use these accounts effectively and build substantial savings. And they point to the challenges that the old pension system faced, the funding shortfalls, the employer bankruptcies that wiped out benefits, the rigidity that didn't serve workers who changed employers or careers. Neither side of this debate has a fully satisfying answer, which is why the discussion continues. Various reform proposals have circulated over the years, from creating universal retirement accounts available to all workers regardless of employment status, to mandating automatic enrollment and escalation features more broadly, to creating publicly administered pooled investment options that would give workers access to low-cost diversified investments without depending on the quality of their particular employer's plan. Some of these ideas have been implemented in modified forms. Others remain under discussion. The fundamental challenge, helping people build adequate income for a retirement that might last 20 or 30 years, is unlikely to be fully solved by any single policy change. Let's settle into a slightly different angle on all of this. We've been talking about the mechanics and the history, but it's worth pausing on what all of this is really for. It's for a period of life when you're no longer working, when the source of income that sustained your adult life has stopped, and when you need some other arrangement to continue meeting your needs. Retirement itself is a relatively modern concept. For most of human history, people worked as long as they were physically able, and the transition from working life to non-working life was often determined by incapacity rather than by choice at a particular age. The idea that there would be a defined period at the end of life, a deliberate withdrawal from the workforce followed by years of leisure and relative financial security, is something that only became widely expected in wealthy industrialized countries during the 20th century. Social security and pensions made it possible for ordinary working people to envision and plan for that kind of retirement. The financial tools we've been discussing, the various accounts and their tax advantages, are the mechanisms through which that vision is funded. The length of retirement has also changed significantly. When Social Security was created and the initial retirement age was set at 65, average life expectancy in the United States was significantly lower than it is today. Many workers who reached 65 would live only a few more years. Today, a 65-year-old in good health can reasonably expect to live another 20 to 25 years, and many live considerably longer. A retirement that lasts 3 decades requires a great deal more in savings than one that was expected to last 5 or 10 years. The evolving demographics of longevity are one of the reasons why personal savings and investment returns matter so much more than they once did. There's a whole dimension of retirement planning around healthcare costs that we haven't touched on yet, and it's worth mentioning because it's a significant factor in how much people need to save. Healthcare expenses tend to be higher in older age, and costs have been rising at rates that exceed general inflation for decades. Medicare, the federal health insurance program for Americans 65 and older, provides substantial coverage, but it doesn't cover everything. Premiums, deductibles, copayments, prescription costs, dental care, vision care, long-term care, all of these can add up to substantial ongoing expenses for retirees. There are accounts specifically designed for healthcare expenses called health savings accounts, or HSAs, which have some of the most favorable tax treatment of any savings vehicle. If you're enrolled in a high-deductible health insurance plan, you can contribute pre-tax money to an HSA, let it grow tax-free if invested, and withdraw it tax-free when used for qualified healthcare expenses. That's triple tax advantage, which is unique among savings accounts. And while the primary purpose of an HSA is to help cover current healthcare costs, unused balances roll over from year to year, and after age 65, the money can be withdrawn for any purpose, not just healthcare, with income taxes but no penalty. This makes the HSA function like a traditional IRA in retirement, with the added bonus that healthcare withdrawals are still completely tax-free. Many financial advisors consider the HSA one of the most underutilized savings tools available. Long-term care is a particularly significant and often underappreciated retirement expense. Long-term care refers to help with the activities of daily living, bathing, dressing, eating, moving around, that becomes necessary when physical or cognitive decline prevents a person from managing on their own. This kind of care can be provided at home by paid caregivers or family members, or in assisted living facilities, memory care units, or skilled nursing facilities. The costs can be very high, ranging from tens of thousands to over $100,000 per year depending on the type and location of care. Medicare generally doesn't cover long-term custodial care, only short-term skilled nursing care under specific circumstances. Medicaid does cover long-term care, but only for people who have very few assets. For people who want to fund their own long-term care rather than depending on Medicaid, private long-term care insurance is one option. These policies pay a daily or monthly benefit if you meet the criteria for needing care, typically defined as being unable to perform a certain number of activities of daily living. The premiums can be substantial, particularly if you wait until your 50s or 60s to purchase the policy, and the insurance market has had some instability as insurers have found long-term care claims to be higher and more persistent than originally projected. Hybrid policies that combine long-term care coverage with life insurance are a more recent development that some people find more appealing because the premium doesn't feel like pure risk transfer, since it also provides a death benefit. All of this, the retirement accounts, the Social Security calculations, the healthcare costs, the long-term care planning, fits together into what financial planners call a retirement plan. Not a single document or a single decision, but an ongoing process of thinking through the likely shape of one's financial life after work ends, figuring out what resources will be available from various sources, estimating what expenses will look like, and identifying what gaps exist between the two. For most people, this process benefits from some professional guidance, at least at certain key moments, though the fundamental concepts can be understood by anyone who takes the time to work through them. And here, at this slower and more reflective pace, it's worth noticing how much of retirement planning really does come back to the same few core ideas that we started with at the beginning. Setting money aside, giving it time, letting it grow, paying attention to taxes and fees, not disrupting the process with hasty decisions. These ideas aren't complicated. They don't require advanced mathematics or detailed financial knowledge. They require consistency and patience, which are in some ways much harder to maintain than any technical skill but are ultimately more important. The accounts are the vessels. The tax rules are the incentives. The investment options are the tools. But the underlying principle, the thing that makes it all work, is simply time. Money that is left to compound over decades becomes something qualitatively different from money that is used and spent. This isn't magic, just arithmetic. But arithmetic applied consistently and patiently over very long periods of time produces results that can seem surprising when you see them laid out. A person who contributes steadily to a retirement account from their mid-20s through their mid-60s is making a transaction with their future self, one that plays out over 40 years. The 25-year-old who sets aside $500 a month probably doesn't feel it very dramatically in their daily life. But the 65-year-old who receives the results of that contribution, plus 4 decades of compounding growth, experiences something substantial. The transaction is slow and quiet and happens without any drama or excitement. It's just money being moved, month after month, year after year, invested in boring diversified funds, growing through the ordinary activity of markets over time. That quietness is actually one of the things that makes it hard. Our attention tends toward the dramatic and the immediate. Slow accumulation over decades doesn't capture attention the way a dramatic investment story might. But it's the slow accumulation, the unremarkable consistency, that actually builds the financial foundation that makes the transition out of working life possible. There's something almost restful about this when you think about it in those terms. The best retirement planning, for most people, looks like almost nothing. It looks like automatic contributions going in from each paycheck. It looks like a target date fund quietly rebalancing itself year after year. It looks like a policy of not checking the account balance more than occasionally, and of not making reactive changes when markets fluctuate. It looks, in a sense, like deliberately not paying too much attention, trusting the structure to work as intended, and directing your attention to the rest of your life. The complexity that financial professionals manage, the sophisticated strategies around tax optimization, Roth conversions, Social Security timing, asset location across different account types, sequence of returns risk, all of that represents the fine-tuning that can improve outcomes at the margin. But the core, the thing that makes the largest difference for most people, is simpler than all of that fine-tuning. Start. Keep going. Don't stop. Don't take money out early. Leave the investments in place. The whole system we've been walking through, from the early forms of Social Security to the pensions to the shift toward individual accounts, from the traditional IRA to the Roth to the 401k to the solo account for the self-employed, has been built up over decades in response to the basic human challenge of funding a period of life when work-based income has stopped. Every piece of the system has its own history, its own logic, its own rules. But at its heart, all of it points back to that same patient, quiet act of setting money aside today for the benefit of a future self who will one day need it. And that future self, 30 or 40 years from now, living on the results of the choices made today, will never have to know about the complexity of the system, the legislative debates, the expense ratios, the required minimum distribution tables. They'll just have the money, or not, depending on the choices made over all those years. It's a conversation across time, between the person you are now and the person you will become, conducted quietly, through the unremarkable mechanism of accounts and contributions and compound interest, over the course of a working life. There's a certain peace in that, once you see it. The decisions don't have to be perfect. They just have to be consistent and basically sensible. The time does most of the work. The structure provides the scaffolding. The rest is just patience. And so we've come to the end of this long, slow walk through how retirement accounts work. We started with the basic idea of tax deferral and found our way through the mechanics of 401ks and IRAs, through the history of pensions and Social Security, through the shift from employer-managed plans to individually managed ones, through investment concepts and fee structures and all the various pieces that make up the modern retirement planning landscape. None of it, taken one piece at a time, is particularly difficult to understand. It's just a lot of pieces, and they take a little while to sit with. If your mind has been drifting through parts of this, that's fine. Some of these ideas have a way of settling in quietly, absorbed without effort. The broad outlines of how these accounts work are available to you now whenever you need them, stored somewhere in the background, ready to come forward when something prompts them. For now, there's nothing more to do. The accounts are there. The rules are there. And whatever rest you needed tonight, you've given yourself permission to take it. Let everything slow down, let the thoughts drift, and let whatever comes next come gently.